Let's get back to the markets. The S&P, the NASDAQ, and the Dow all coming off what was the best day they've had since May 27th. Goldman Sachs Chief U.S. Equity Strategist David Kostin joins us here on set. David, good to have you towards the end of earnings season. And I wanted to come to you on something we were discussing yesterday, which was the market outperformance on earnings growth of the Mag 7 minus NVIDIA, so really 6, right, versus the rest of the market. You make a point of it as well in your notes, 26% year-over-year earnings growth versus something like 4% for the rest of the S&P.
Right.
What do we make of that, and what does that mean for the market?
David, I think the thing you should take away from that is the expectation was going into earnings season, it would be 14 percentage points, and it ended up being 22 percentage points. I think that is a key number to think about, that the surprise, the magnitude of the surprise, was really concentrated in those magnificent 6 until we get the NVIDIA in a couple of weeks. So I think that's a key issue. I think the broad takeaway from earnings thus far, we're about, at the end of this week, we'll be about 85% of the way through earnings season, is that you had positive surprises, you had guidance, and the commentary from management was generally positive. And that's a good backdrop for equity market, generally speaking. So first of all, you had 2/3 of the companies beat earnings expectations. So expectations coming in was around 4 percentage points of earnings growth. It ended up being, thus far, 9. So that's a positive surprise. Now, admittedly,
although almost all of it was due to 6 companies.
A lot of it came from there.
But the rest was 4%.
Correct. It was still positive, surprises or expectations. The second is the improvement, the guidance, and companies were raising guidance. And I think here you get a sense of the breadth of what's taking place. You had basically half the companies this quarter raise guidance for the forward year, whereas in the first quarter, only about a quarter did. So therefore, you had these results. And to your point, yes, you had good results in the Magnificent 6 thus far. But really, it was the breadth of their commentary. And then the third issue we take away is, what did management have to say about things? And they are of the view that they can mitigate the cost of these tariffs. And that's an important distinction. That's really where most of the portfolio managers are really asking a lot of questions on right now. It's tariffs and rates. And the tariff side of it is 60% of them expect to raise rates. 75% think they're going to push back on their suppliers. And ultimately, they will be able to maintain their margins.
60% think they're going to raise prices.
Expect 75% to raise prices.
They're going to push back. But
right, in terms of their commentary. And obviously, some of that they'll have to absorb as well.
Do you think they would actually say, though, if they weren't able to mitigate the tariffs? I mean, coming onto the conference call, isn't their job to be like, guys, we've got a plan, here's what it is, and we'll kind of find out later what the real impact is going to be?
Well, Leslie, it's an excellent point, because some of the commentary in Washington, D.C. looks at, are companies actually going to raise prices? But they have a fiduciary obligation on behalf of transmitting to shareholders what's actually likely to happen, and their policy and their strategy is to raise prices right now. I'm not saying their only strategy, obviously looking to push back on their suppliers and try to reduce the input costs, but ultimately someone has to pay for the tariffs. And thus far, managements have said they're able to cut costs and push back the suppliers and raise prices, and thus far maintain their margins. And that's really the key issue, because the economy is growing at around 1% rate. That's real GDP 1% below trend. You have inflation that's closer to 3%. That means your real GDP is around 4%, and 4% real GDP is what most companies grow their revenues, their top line, at nominal GDP, about 4%, which means in order to get 7% earnings growth, you need to get to building blocks that's going to incorporate margin at least flat, maybe a little bit higher.
So given all of that, do you think that the big tech earnings have been cushioning some of the macro news that we've seen? How would you kind of characterize the market's response to the headlines, especially of the last week?
I would characterize it in terms of the narrow breadth of the market, that a relatively large percentage of the return for the index, the top line index, is coming from these companies. Admittedly, they're about a third of the market cap of the index, so obviously they matter a lot. That's, I'd say, the key takeaway. And they are, driving a lot of the conversations around AI, around efficiencies, that other companies are spending money. And so those themes are ones that really are capturing most of the investor conversations right now.
Now, is that what you would advise investors to do, is essentially defer to that market message? It's the AI theme driving most of it, or are there other places to look? I mean, you have actually seen cyclical stocks relative to defensive ones hold up pretty well, even though we're talking about subpar GDP and, maybe the need for rate cuts.
So like the message that we look at, the analysis we look at, is that the cyclicals relative to defensives are pricing, equity market pricing, as though the economy is growing closer to 3%. It's not, but the equity market's pricing as such. So we're concerned on the move in the cyclical stocks, and a lot of the conversation is around the largest companies. And so I think about AI in terms of phases. And so a lot of this move has been in the infrastructure-related companies, infrastructure kind of related to AI, utilities, power companies, some of the semiconductors other than NVIDIA, and focus more on the application software companies, where a lot of the their customers are spending money to try to get the data in a way that they can use and apply AI. So that's, I think about the phases around AI, and that's the phase we're focused on right now.
Anybody else? Anybody for Kostin?
Well, I mean,
don't force it. I mean, all right. So what about your targets? What does it all mean?
So what does it all mean? We got the S&P index at around 6,600, about 5% up from now to the end of the year, and about almost 10% to 6,900 at the end of 12 months. So looking out 1 year from today, that's the expectation. That's a reasonably solid return around the idea of earnings growth, David. That's the key. Earnings growth of around 7% this year, 7% next year. It's the trajectory of earnings as opposed to multiple expansion. Stock market trades at 23 times earnings, so it's a really, really expensive, historically speaking, expensive market. And the typical stock trades at 19 times, which is still high, but not as high as and that's the impact of the largest companies in the Bank 7 in terms of lifting the overall market.
Which obviously also have higher growth rates. David, thank you as always. Appreciate it. David Kostin.